Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Monday, February the 2nd, 2026, recording this in the morning, just about 6:45. Okay, so obviously we had the big metals sell-off um, last week. We also had the nomination of Kevin Walsh, etc., etc. So let's just have a look and see what's going on. And I think probably what's going to happen, we'll get a period of consolidation. So I've got a few charts which we'll look at, which will help us to sort of orient ourselves. But firstly, just what I spoke about a little bit in yesterday's sort of macro overview video is the fact that the VAR, which all institutions use to measure their sort of the value at risk, which has a heavy input, obviously, of volatility and maximum potential sort of hypothetical daily drawdown, that could be under a bit of pressure today. So the point is that we could still see a little bit of deleveraging, because although there was a lot of deleveraging in the precious metal space and in copper on Friday, obviously, it could be that some of these sort of institutional trading books needs to be rebalanced and maybe deleveraged a little bit more because of the heightened volatility. So the point is that, in my humble opinion, today we could still see a little bit of volatility and some a little bit of reduction in risk overall. So let's look at some of the issues in the volatility space. If we look at the VIX itself, it's off its highest levels, but for sure, it's up at around about, over the 19 handle, and that's quite a long way away from the, the sort of the placid periods we had, back in end of, in the September, October, or even the beginning of this year, where it was like 13, 14, 15. So definitely a bit of heightened volatility in equities. And whilst that's not in itself a massive sort of headwind, we can't also say that it's a tailwind in any shape or form. So we need to see this sort of VIX, keep an eye on that, maybe the VIX futures today, they need to come down a little bit. And if we actually look at some of the VIX futures, you can see that they've been making sort of higher lows. So the point is that in the VIX futures curves, February, March, April contracts, they've actually been sort of ticking up a little bit and are just finding it difficult to go down. So still a little bit of volatility. If we also look, obviously, at the metals volatility, no surprises there. We see gold volatility at extremely high levels, and obviously in silver volatility, we see that also at very high levels. So the point is that there's still volatility all in most assets. In FX as well, there's high volatility. The bonds are doing okay, but as you can see, they're off their lows. So it's still obviously quite low volatility if we look at the MOVE index, but still just creeping up a little bit. Point is, one needs to be sort of awake today. Okay, what I want to talk about is a few different sort of charts. So let's have a look. We have I'll just put up the Australian dollar here, because the Aussie dollar, let me just bring that up. Actually, sorry, just let me find it here. So here we go, AUD, USD. So we can see here that the Aussie has been on a bit of a tear for the last couple of months, going up a lot. There was, sort of, why has that been happening? Because, inflation is proving pretty sticky. The employment situation is very good in Australia. We had the last employment numbers. The unemployment rate was down to 4.1, which is very good. Housing prices, I was just looking at some data over the weekend. Housing prices in all of the main Australian cities have been going up a lot. So the point is that the RBA is meeting today, and let's just look at a few charts here. They are scheduled to just compare this here to some of the other central banks. So the Reserve Bank of Australia here is this sort of orange-red number, and you can see here that, like everyone else, they hiked, then they're on a pause. Then they actually cut relatively aggressively, three or four times, sort of in the last 12 months or so. So you can see here, compared to the Fed, which is in the black, basically about the same. But actually, the RBA is expected to hike today. So there's about 19 to 20 basis points of a hike priced in. So that's about 80% probability, according to the market, that the Reserve Bank of Australia will hike this evening. And so why is that? It's also because you see here that the Australian dollar, trade weighted index here, you see the Aussie dollar here has actually been ripping high. So that's getting quite high. So the question here is whether is this going to be the beginning of a hiking cycle, or is it going to be a sort of a one and done? So maybe not a hiking cycle. Maybe it's just going to be a one and done, just to calm down inflation a little bit, maybe to sort of cool down the housing market here. Because the point is, as you can see here with the trade weighted Australian dollar here, you see this here in the black, it's gone up a lot, and that's already sort of tightened financial conditions. So that stronger Aussie dollar, in a sense, has done a little bit of the RBA's sort of work. So let's see what they have to say, the RBA. if they indeed if they do sort of hike. I mean, it's not a guaranteed, but as I say, about 80% priced in by markets. So if they were not to hike, that would actually be a bit of a shock. So could it be, a very hawkish hold? It's possible, but it's looking like sort of a prudent insurance hike. Now, in terms of the technicals, as you can see here, we've got a very key level here, which we're just finding a bit of resistance at about 69.25. Obviously, the Aussie dollar was a little bit overextended. It's come back. If we look at some, just put on some sort of technicals here, let's look at the EMAs. You can see here that it's still a very positive sort of uptrend. And obviously the Aussie dollar, like a lot of the sort of commodity currencies and the emerging market currencies, took a bit of a hit last Friday as sort of industrial metals, but especially the precious metals came down. So this is a good reset because, in terms of the RSI and being overbought and whatnot, the fact that this came down here is a nice reset, blew off a few sort of week longs. If the RBA hikes and indicates, obviously, that if it's the start of a hiking cycle, that's a bit unexpected, but that would be very bullish. If generally they say that, the economy is doing well, they're a bit little concerned about inflation, and they don't rule out the possibility of further potential hikes rather than signaling clearly it's a one and done, can the Aussie sort of resume its move upwards? I think absolutely the answer is yes, but we'll have to see. And of course, that's going to depend on the US dollar. Okay, so let's just go back and look at a few other charts. So I just want to look, let's first of all look at the at just the technical perspective here on the metals. We all know what happened. There was a big blow off. So just where we're at now, you can see here though, what I want to just keep in mind is that if you look actually at the moving averages here, you can see that this has been in a beautiful uptrend going back. I mean, I don't know how long, where do we go back to? At least let's say a year, 15 months, something like that. So, was this a sort of a massive blow off, the worst since 2013? Yes, it was. But you can see here that this actually will reset the stochastics in terms of the RSI, the MACD, the Bollinger Bands, all of this kind of stuff. All of these sort of overbought measurements will have been reset. And you can see here that essentially what we've got, if we anchor the Fibonacci from let's say the 28th of October, you can see here that it was such a strong run up that it feels like a horrible, horrible sell-off, which it was. But you can see here that we're just gone back to the 61.8 fib, maybe a bit deeper into the 61, into the 65% fib. So, a nice retracement. You can see that gold at least is already starting to push higher. Now, does this mean that one should pile into gold? Maybe not. We probably at this point, normally after a brutal sell-off, one normally would likes to see some kind of sideways consolidation and a nice strong basing formation. We need to see the base starting to form. But what I will say just in terms of the technicals is that in terms of what the bulls need to do, let's just put it here. You could say that, they need to, as I like to say, achieve a few hurdles. They need to sort of go over a few hurdles. And you can see here that the 38% fib retracement, that measures out to about, 4,880 or so. And you can see here that that actually failed. So, we had a reactive bounce, which is nice to see for the gold bulls. But at the first hurdle here, which was the 38% fib, they actually failed a little bit. So still more work to do there for the bulls. And probably what I estimate what could actually be more sort of logical might be some kind of sort of basing formation here where, we just need to see, something like this kind of price action, maybe even for, a few weeks or so, just before the gold can resume its move higher. Having said that, the macro factors are still relatively in place. We still have a little bit of sort of policy chaos from the White House. There is still geopolitical risk around the world in different shapes and forms. Central banks are still buying. Retail maybe is going to be a bit scared by this, but in terms of countries like Turkey, Iran, Brazil, China, Japan, India, these countries, there's still quite strong retail demand. Will it be dented because of this? For sure. We have the Chinese New Year holiday coming up, the 1 week holiday coming up fairly soon. So for sure, we can have a sideways consolidation. But at the end of the day, the lack of fiscal discipline by Western governments Western treasuries is still in place. So, can gold resume its uptrend? I do believe so. But we possibly need just a further, as I said, sideways consolidation. And this level down here, you see here, this level about there on the 21st of October, and also around about the end of last year, at around about the 44 144.30 level looks pretty good. You see that's where it bottomed out. So if we get some kind of move back down here, sideways consolidation, that's looking pretty good. Similar kind of situation in silver. I mean, the pullback there, silver like platinum, palladium was a bit nastier. But as you can see here, again, if you anchor off the fib, let's say to the beginning of this uptrend from about the 21st of November, similar kind of situation to gold. You see here, it bottomed out at around about $71.50. But again, like a deep fib retracement here, 60, 61.8, 65 pocket. But again, as I was just saying about gold, what we need to see for the bulls, if they are to, is again, the first key level is the Fibonacci level at about 90 and 3/4. Again, it sort of failed there. So, it's possible that we had this reactive bounce. So is there possibly more downside? Maybe. And is there a potential for sideways consolidation, multi-day, maybe even 1 or 2, 3, 4 weeks? Yes, I think similar kind of situation to gold. So personally, I'm not going to be dabbling in silver until and unless we see some kind of sideways consolidation. Probably a nice, attractive entry point could be, something around in this pocket here, like say $72, $73. But as I say, you'd probably want to see some nice sort of settling and a little bit of consolidation. And maybe, as I was just saying before, after the Chinese New Year and the Chinese retail buyers come back, if they do come back. Excuse me, a little bit of that. Okay, just in terms of that leveraging as well, just to give you a sense of that, just pulled out a couple of charts, just to give you an idea of what happened on Friday as well. If you actually look at some of the ETFs, I've just got here, for example, SLV, and you can just see how overextended the market was. So you can see here there's millions of contracts. So you see the calls open interest. So you see what happened here, that the calls open interest, which is this red line, massively ramped up. And just reading some research over the weekend, and apparently it was just a lot of naked calls. So basically, a lot of retail people piling in to the SLV, but also the leveraged ETFs. And of course, if you have a naked call, the dealers who have sold them that naked call, they're exposed on the upside. And of course, they need to sort of buy futures to hedge. So you got this massive ramp up in price. But as soon as you get any kind of sort of selling, then what happens is that as that gamma starts to come down and the delta hedging necessary by the dealer starts to reduce. So instead of having a delta to be hedged of 70, 75, 80, 85, something like that, as that delta gets reduced, then we have the opposite reaction, which is the dealers start to unload all of their hedges, which basically means selling. So you get this sort of acceleration to the downside, and that's what you can see here. So you see the turnover, massive volume, and that huge volatility. And then that's even sort of magnified when you start talking about leveraged silver ETFs. So for example, you look at something like AGQ, which is a ×2 leveraged ETFs, and just from the research I was doing over the weekend, they had a AUM, so assets under management, of about over 5 billion, about 5.3 billion. Now that's a ×2 leverage, so that means that their futures exposure is about 10.6 billion. And basically, as that price came down, they have to in terms of their exposures for future, you can see as the number of the billions they had under assets under management here. That's what this red line is. They have to massively and very, very quickly deleverage because they're balanced at the end of every day. At the end of every day, they have to rebalance. So something like the AGQ, which is all cute on the way up when you're sort of massively leveraged, but on the way down, they have to massively doubly, it's a ×2. They have to reduce their futures positioning. And so that was obviously caused a cascade in selling. Point being that a lot of these moves in the precious metals, it doesn't necessarily mean that the global macro framework for their strength has changed. It just means that there was, obviously a bubble and a lot of over leveraged players. Now, once the dust settles, my point is that, could some of these uptrends and strength resume? I do believe that's possible because, again, if you look at silver, just looking at the moving averages here, you can see here that this is still in a positive sort of uptrend. Now, has it been damaged? Yes, there's been some, pretty nasty technical damage, but as you can see here, we're only getting back to prices, essentially at the beginning of the new year. I mean, this is the 2nd of January price. Here we are 1 month later. So the point being here is that silver and gold and platinum, palladium, of course, also had a big sell-off. But if they can reset, there could be a resumption in the positive price action. Maybe within the next few weeks or so. Let's see. Now, talking about What else is going on? Let's get on to a few other things here. So, just in terms of Wash and what's happening, people saying, is he a dove? Is he a hawk? There was a big sort of missive sent over the weekend by Claudia Sam. Like no one, everyone's trying to figure it out. I personally think the best thing to do is just to look at the actions, and rather than trying to anticipate what he may or may not say. I mean, he's not taking over the Fed until sort of the May, June. Let's just see what he has to say and what happens. But definitely ways of looking at that. Let's just look at a few charts which could give us sort of some indication. So charts which I'll be looking at to get sort of some sense of that is, first of all, is a Fed pricing. So if we look at just the way the market reacted, so I'm going to look at the what's priced in by the SOFR contract. So let's look at sort of June of 2026, when in theory he'll be sort of taking over if he is sort of confirmed. And you can see here the markets did take him as being a little bit more dovish. Okay, so the pricing for, let's say, this is the June pricing. You can see here sort of more cuts being priced in. If we go out to September, you can see that the market quite liked it and priced in a more a dovish path of the SOFR. And if we go out to December, you can see even more so. So the market's certainly saying, hey, this guy is a dove. There's going to be enormous political pressure on him to cut. So could they cut? Could the Fed cut, not 50 basis points as the market was pricing in by the end of 2026, but maybe 75 or even 100? And, we're not there yet, but definitely the first reaction from the SOFR's market, the extreme front end of the curve, is yes, for a more dovish Fed. So that's definitely something to be looking out for. What I'll also be looking out for is, will the yield curve steepen? So if we look at some of the spreads, let's look at the twos, tens. You can see that it is starting to steepen. If we look at, let's say, the twos, 30s, that's also starting to steepen. And also, if we look at the fives, 30s, you can see that's also sort of steepening. So the narrative is sort of still in place. And, the market is confirming that people say, oh, Wash is a hawk and everything. But I think we have to be a bit more nuanced. The market seems to be saying that, hey, at the front end of the curve, there is more scope for sort of cuts. So that's going to sort of keep the front end yields, like the 2-year yield I was discussing in yesterday's video, sort of anchored and even maybe coming down a little bit. But that basically means, that as the government, the US administration continues to spend money, there's a lack of fiscal discipline, a strong economy, or at least a relatively robust economy, potentially inflation remaining sticky if the Fed is not going to be chasing the sort of really attacking inflation. That's going to lead sort of for the 10 and the 30-year yields to start pushing up a little bit more. And so we're going to keep that steepening of the curve. So that's definitely something to be looking out for. And that could be another trend. And if you look at something like 5s, 30s, there's more room to go. It could get up to 115 basis points. If you look at the 2s, 30s, that could easily, even very short term, get up to 140 basis points. If you look at the 2s, 10s, that looks as though it could be breaking out. So the point here is that, it could have a steepening of the curve anchored by, softness at the front end. When I say softness, I mean softness in the yields. So those yields are sort of coming down a little bit, and the front end SOFRs are continuing to go up. Now, that would imply potentially, a weakening still of the US dollar. So if we go back to the dollar index, actually, let's go back. Sorry, let's put it in the FX section here. So if we go back to the dollar, now we know that the dollar's had a nice bounce over the last 4, 5, 6 days. But the point is here is that, if we get all of those factors, like a Fed which is continuing to cut, and still a little bit too much inflation, we could see the dollar maybe just sort of drifting down here back to retest these lows at 96, and maybe even breaking lower into the 95s and the 94s over time, if indeed Wash does sort of shepherd the FOMC towards sort of cutting a little bit more. But let's keep an eye on the technicals. You can see here that the moving averages are still pretty weak. They're just going flat, and actually flat to sort of negative. So let's not get too excited about the US dollar here. Despite the sort of the move on Friday. And again, the move on Friday, people saying it's wash, but the reality is we've got the PPI, which was a bit higher than expected. We're having quite strong data, and we had this huge sort of sell-off in the metals, which leaked over into the dollar space. So let's keep an eye. Here's the fib retracement level. And as you guys know, I always like to say the bulls have work to do here. This is the 38% fib at about 97. Let's see if it gets above there. It really needs to get up to 97.5, and then eventually up to the 68% fib retracement at 98. We're not there yet. So let's see what happens over the next day or two. And if the dollar can't do too much more, the path could still be down. And generally, if we see this dollar weakness and we see a Fed in a cutting cycle, a Fed in a cutting cycle with dollar weakness potentially is always very good for emerging market FX and emerging markets in general. So if you look at some of these emerging markets, we can see things like against the peso. I get it, the dollar went up for the last day or two, but if you just look at the peso here, or the US dollar versus the peso, you can see it's been basically in free fall, very, very weak. If you look at something like against the South African rand, again, bit of a bounce on Friday, but the South African rand has been very, 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 very strong. And could we see sort of continuing strength in the emerging market FX space? Again, Brazilian real doing pretty well. See US dollar weakness. So let's just see what happens today. But the US dollar, has had a nice little bounce for 2 or 3 days. But I definitely think there's more scope for US dollar weakness over time. And again, if inflation comes down, a lot of people are talking about a high productivity, low inflation environment. This seems to be Walsh's base case that, AI is going to lead to higher productivity and will be ultimately deflationary over time as well. And just finally, we're just talking about gold. That's probably going to have a consolidation. I think medium term gold is probably the one to be in rather than silver. So, but as I was just saying, talking about the precious metals, I think the macro factors are still in place for a relatively robust bid in gold over time. So they're the five charts which I really want to be looking out for. Just a couple of other things while we're talking about the FX here. Keep in mind that Takeichi of Japan, we have the election this weekend, which is going to be very, very interesting. She was on the campaign trail and said a few things basically to the effect over the weekend that, hey, a weekend was ultimately pretty supportive for exporters, for Japanese exporters. And so the yen didn't like that at all. And you can see that the dollar, apart from anything, had a bit of an extra rally, but giving it back a little bit here. So she needs to be careful with what she's saying. And the markets don't like any talk at all of how wonderful the weak yen is. And so let's just keep an eye on the lead up to the elections. And of course, this weekend, her Liberal Democrat Party is expected to sort of increase its majority in parliament. And again, she is on record as favoring sort of a relatively loose fiscal policy, a stimulative fiscal policy, which the yen does not like at all, nor do the Japanese JGBs, the government yields, the 30 and 40 year. So we could see a bit more of a spike up in those yields. We'll look at that. Okay, apart from that, guys, we have the ISM manufacturing today. Let's keep out on the data. We have a lot of jobs started this weekend. We have JOLTS, we have initial jobless claims, of course. We have and of course ADP, and then the big one we have ISM services on Thursday, and then we have the non-farm payrolls on Friday. We'll talk about that a little bit later on. But I think that's probably enough from me for this morning. Have a great week. Have a great trading day. So hope you enjoyed the macro snapshot from the macro shop. Thanks very much. Take care. We'll be back again tomorrow. Thank you.